Welcome back to Chai with Siddick, your weekly 5-minute market roundup. No noise, no panic, just the numbers that matter. Pour yourself a cup and let's get into it. Last week on this show, we talked about the extraordinary bull run in US markets, 9 straight weeks of gain, AI Europhia in full swing, and the S&P touching all-time highs. Well, this week, the party got a reality check. Let's start with the big story. Friday, June 5th, the US job report drops. May non farm payroll 172,000 new jobs created. The estimate was just 80,000, more than double what Wall Street expected. Now, normally you would hear that and say, great, economy is doing well, but markets don't always play that game. Strong jobs data means the economy is running hot. Hot economy means the Fed might have to raise interest rates or at least not cut them. And higher rates are bad news for growth stocks, especially AI and semiconductors. The result, the S&P 500 fell 2.6% on Friday alone. The Nasdaq 100 dropped over 4.5%. Nvidia, the AI darling, fell 6%, about $1 trillion wiped from US tech evaluations in a single session. Now here's the context for us as long-term investors. The S&P 500 is still up massively from the March lows. We are still in a bull market. But this week was a clear reminder markets don't go up in a straight line. And when sentimental shifts, it shifts fast. Now let's talk India. Nifty 50 started the week beautifully, hit weekly high of 24,089 on Tuesday, but by Friday it had given most of that back, closing the week at 23,547, down about 0.7% for the week. Sensex similarly closed around 74,243, also soft. The culprit, the RBI. Reserve Bank of India announced its latest monetary policy decision. The RBI kept the repo rate unchanged at 5.25%. No surprise there. But the language was cautious. They raised their inflation forecast and cut their GDP growth projection for the current financial year. The combination, higher prices, lower growth. It's a tough environment and markets didn't love it. For us, NRIs with mutual funds investment back home, this is worth watching. The RBI is essentially saying we see growth slowing. That matters for rate sensitive sectors like real estate, NBFCs, and banking. The silver lining, India's market are still trading significantly below the September 2024 all time highs. If you are a long term SIP investor, this kind of week is background noise. Right. So, what are we watching next week? In the US, Fed speakers, multiple Fed officials are scheduled to speak, and after Friday's job number, every word they say about rate hikes will move markets. Watch the 10-year Treasury yield. If it breaks above 4.6%, tech stocks will feel it. In India, watch for any FII flow data. Foreign institutional investors pull back this week. Whether that continues or reverses will set the tone for Nifty. And one for the NRIs, the INR AD rate, the rupee has been range bound. Any RBI signaling around liquidity or intervention is worth tracking if you are planning a remittance. That's your week in markets in 5 minutes. To quickly recap, US markets fell hard on Friday. A strong jobs report triggered rate hike fears. Nasdaq down 4%, Nvidia down 6%. Indian markets gave back early week gains. Nifty ended down 0.7% as the RBI raised its inflation outlook. Both markets are telling the same underlying story. The easy money era is officially over. Fundamentals matter again. If you found this useful, hit like, subscribe, and I'll see you next Friday, same time.